Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
We encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Let me ask you about this. Maybe you can speak a little to this for the listeners. Talk about demand destruction. What's that all about?
You know, the big deal here is that America is a country that really depends on our consumers. So when we have anything that affects our consumers in a negative manner, and some of the slides we're just looking at where we looked at these bars where we've got less demand, it really trickles through the entire economy, not just the consumer-facing companies, but all of the producer and business-to-business companies as well. And so that could be the result of higher inflation. We could be really in trouble there. One of the slides that I like to point out, you know, is really interesting to me. I'll share with you here, Nate. And again, I'll try and paint the picture for our listeners, but imagine a chart that goes back to, 20-something years ago, back to the 90s, at the bar graph. And what this is showing is the change in mortgage rates. And so it's the year-over-year up or down percentage change in a mortgage rate. And since the 90s, we've had a lot of declines in mortgage rates. Nate, when you and I bought our first homes in the 90s, and we would have paid probably 9%,
8%, right?
You paid 9%? Yeah, right. We were, I think Stacy and I were right under 8%, and we were elated because I think we got in there on the day of.
You must have had income. See, I didn't have income, so I was probably a higher credit risk.
I wasn't as ambitious as you were trying to work in Washington like you were back then, but yes, we did have income. We were credit worthy, and that's about 7% higher than rates today, right? I mean, it was really high. Well, the big deal here is that rates have gone up over the past 3 months in 2022, higher than any year in history. So already this year, rates have gone up more than 1%, 1.25% in mortgage rates, just this year, just in 3 months. So this will be a record-setting year for the increase in mortgage rates. Well, that will be good for some people, but really it's going to be bad for most of us. That for new home buyers, this is destroying that demand because now they're not going to be able to buy as expensive of a home. So all of us existing homeowners who may want to be selling will have, there'll be more homes on the market for lower prices because we're not going to be able to demand the same prices that we could last year when it was a seller's market, when there were just so many buyers and rates were so low. So this is a huge, there could be a lot of trickle effects with this. It hasn't hit things yet. In Colorado, of course, we've got massive demand after the horrible Marshall fires. There's 1,000 homes that need to be built in the Boulder and Denver metro area, all within the next 2 years, or they're not going to get paid for by the insurance companies. So that's a huge upward demand, a lot of demand.
Plus,
huge upward,
the real estate. Yeah, just to point out on that one, the real estate market is very geographic centric too, because Colorado's just getting a ton of influx from other locales as well. So add to the normal 40,000 units we have to build a year, another 1,000, and I guess that's material. But let me pause you for a second here and look at this chart that you put up, because I'm I'm trained in probably the same skill you are to look for patterns here. And one of the patterns I'm seeing is with each of the significant increases in mortgage rates, it's usually followed, most of these are followed by are these 3 quarters? Are these by quarter that we're looking at?
Yes, those are quarterly rates.
So 1 quarter increase in mortgage rate is typically followed by 3 quarters of decrease in mortgage rates, and that seems to be a fairly consistent pattern. So what I would see here is, yes, we have a significant uptick in the mortgage interest rate. What we'll be curious to see is what happens next. Do we have
Great
a
point.
do we have a pullback in that where it normalizes again, or do we have sustained increases? Are we going to get mortgages back up into the 5s and 6s for a sustained period of time, or is it going to spike up for a little bit, kill the demand, and then bring it back online?
I love it. And, we will only have to wait and see, because certainly over this period of time, interest rates have been on a long downward trend, and they reached zero. And that can't be the future now, right? Now,
right.
As of this week, the Federal Reserve is saying, nope, we're going to raise rates. The guess now, and this will change probably by the time the podcast goes live, because it's changing every day, the 8 increases before the end of 2022. And that would be pretty dramatic if it actually happened. That would precipitate the highest annualized mortgage rate increase, maybe in history, certainly during this period of time.
Just in time for me to get a new mortgage. How about that?
Yeah, that's what you need, Nate. That's what you need. Well, maybe you need to talk to your financial advisor.
Yeah, we won't go permanent until middle of next year probably, but still not fun.
Yeah.
So,
well, the good news is, I've got a stat here that I emailed you there, that this might make it easier for you to buy your home, that if you're like an average American, you've got 14% of your year's spending in excess savings, and you've tucked it away in your checking and your savings account. And what that whole bunch of nonsense that I just spewed out to you there means that people are saving their money, that they haven't spent it, that during all of this inflationary year, when we've been locked up at home with COVID, when we've been worried about all the things we've been worried about over the past year, we haven't really spent our money like we want to. Well, that's good news. That should make it a little easier for you to buy your home, right, Nate?
Sure. Yeah. No, it's absolutely true. And as long as, business stays good, then the profits and future revenue are there as well. I want to shift gears to one other thing here real quick before we round out this discussion. Just another kind of educational discussion before we get to what should we do, because we always like to end these things with action. How should I address inflation in my personal life and my business? But one other thing I want to ask you about that's always been a bit of an enigma to me. How does you mentioned that the Fed has a couple of tools to pull back on inflation, which is usually driven by too much money printing, as it were, too much dollars out in the marketplace. We talked about interest pulling some of that back. But what other tools do they have? I've heard of them doing buyback programs on bonds, and what other things can they do to bring in the money supply?
Boy, they're infinitely creative. But the other big tool, and you called it out, and they put the euphemism on it as quantitative easing. But there's really only 2 tools, and the other one is the balance sheet. So I don't have the chart in front of me, but it's huge, and our listeners have probably seen
9 trillion, I think, was what I heard last.
Which is just enormous, right? It's so big. It's an unfathomably large number. I think it's bankrupting 9 million millionaires or something like that. All of their money would be wiped out just to pay that off. So that's not right. That's not a realistic concern. The size of the balance sheet has ballooned while the federal government has spent money that it hasn't yet brought in tax revenues. So all of that money is created by the banks and facilitated by the Fed. And what the Fed can do is with these bonds is start to reduce and you call it bond buyback, which is an option, or just let them expire, which is reducing the amount of dollars that are in the economy by bringing the dollars back into the Fed, effectively making them disappear from the economy. That's the other thing that the Federal Reserve can do, and that takes time. They can expedite the bond buyback by stopping the quantitative easing, which is still going on today. It's scheduled to stop soon, but in any rate this year. I don't have the exact date memorized, but that's the other thing it can do. That's the other big tool, and so I would expect that to happen. But we don't make macroeconomic predictions at our firm. We might invest with somebody who does. But that's the other tool, right? You reduce the amount of dollars in the economy, and that helps slow down inflation. And so that just makes common sense.
So just to summarize, as we move to the what do I do portion of our discussion, inflation is happening. I mean, it's real, although it's not even across all sectors of our economy, our lives. Gas obviously has jumped more than perhaps some of the things that we need for daily living. Rent and mortgages, as we've pointed out, are typically lagging indicators or lagging affected because you're in a 1-year lease, a 2-year lease. Your rental rates won't reset for another year or so, depending on when you went into that. So, and then mortgages are typically permanent, so it's just the new homes. So those are the details that are impacting our lives. Now, how do we protect ourselves, Carl?
I love that. I got three basic ideas, and they pipe in too. But one of the best things we can do, believe it or not, is switch what we're doing already. So when you have inflation and everything that you want to buy is if you knew it was going to continue to be more expensive in the future then, and you knew you had to buy it, you'd want to buy it today, right? You would accelerate your spending and buy whatever it is earlier rather than later at a higher price. And so we have not seen that in the statistics that I just mentioned yet, but that will be the next stage of inflation or a future stage in any event. You'll start to see companies announcing sales like they did in the early 80s, where they said, buy a shirt today because on Monday it's going to be 15% more expensive. And so then that's the sale, right? The sale isn't that the price is going down this weekend, the price is going up on Monday. So if you buy before Monday, well, that's a real sign that inflation is here to last. So we're going to have a natural incentive to spend earlier, and people already feel that. But one way that people could do things that won't necessarily cause inflation and do that is to buy it on services. So I don't know if you've looked at air flights or anything like that. Those prices are up. Certainly restaurants are more expensive than they were a little while ago. I think that trend, if you believe it's going to continue, you could spend it on services because those don't directly go into the inflation mechanisms like others, and a lot of restaurants and a lot of these service providers need it. So it's a natural incentive to want to do those types of things, and a lot of us are just pent up, frustrated, ready to travel and vacation, so do it, right? I mean, do it before it gets more expensive. Go and enjoy it, and it's less inflationary than going and buying goods. And so the second thing, and this is really the big one, I mean, the biggest thing you can do is invest, because had you invested money in equities in the S&P 500 or something in I'm not making an investment advice decision here, but I'm telling you that had you done this during the inflationary period of time, over any short period of time during the 70s and 80s, it might have felt not great. It might have felt like a really stressful time to be an equity investor. But if you had done that and held on to it and been able to hang on to it during those hard times, your equity investments would be worth more today. And so that's the type of decision that a person can make during an inflationary period of time, is to look beyond the short term, to say, I'm going to need more money in the future because inflation is destroying my purchasing power. I need to put money away and invest in something that's going to exceed the rate of inflation so that I can maintain my purchasing power and live a life later with dignity and independence. And then the third most practical thing you can do over the short period of time, while you do those other two, is to prioritize, right? Is to prioritize your spending. And Americans are already doing that with the chart we first looked at, which is, well, we plan on spending more on food because what cost me $90 at the grocery store a few weeks ago is 115 today, and what's 115 today might be 140 tomorrow. So I better be ready for higher inflation rates. And so just to sit down and prioritize, and all three of these, by the way, is what you can do with your financial planner. So that's a perfect opportunity for you to make a financial planning relationship and get real about what really is important to you with your goals and values and relationships. Put your money in alignment with those.
Yeah, absolutely. And I think whenever we see these types of periods come along, I'm thinking back to the Great Recession as well. It gets back to that kind of recalibrating our lives. I'm talking less about the dollars and cents now, and just kind of our where our attitude is, where our heart is, and just recalibrating how we spend our time, how we spend our money, and when we're not so flush, when we're a little concerned about the market, maybe this doesn't help the situation. Maybe this is essentially the demand destruction the Fed is after. When we start to feel a little uneasy about the future, we can focus more on those things that really just are at the core and are not the distractions that we spend. So that's a little bit different than your idea of going out to eating and traveling, but I sense that a lot of people will take stock, and we've seen it in the real estate market where people are right sizing out of these McMansions into much more affordable environments. And so I don't know. I think a lot of it depends on, again, like what you said, how long is that curve protracted out from now? We've now been hearing this for a little over a year, that inflation exists and inflation is a problem, kind of in that non-generic general sense. But
Yeah.
is it going to be the 70s
and
all over again, or is it going to be that's I think the ultimate question that's hanging out there, is how long will we see this?
that
We're
is a
certainly not
great
the
question.
Weimar Republic. We're not going to see, or
No,
Argentina. That's
no.
that's the extreme,
No.
obviously, but we're somewhere on the spectrum of Great Recession to stagflation of the 70s.
Yeah, I think there's a possibility of that. It is a completely different situation now than it was in the 70s, and we live in a world of amazing opportunity today that we couldn't have fathomed in the 70s. But there are so many parallels, and we have so many challenges in all parts of our world. So yes, I think that there's a chance that this could last longer than we're comfortable with. The biggest sticky part of inflation that I see so far are wages. Once you start paying people more, they're not going to work for less, not easily. So that will stick around. And companies and business owners are struggling to also keep the pace of inflation with their prices. And so some companies can do that more easily. It's more easily for a producer of inexpensive items to raise their price by a nickel or a dime, which for the producer is 5 or 10%, and for the rest of us who are buying a item for $1 is not a big deal. You mentioned Starlink. That might be a big deal for some people. I know I got an invitation from Netflix to increase the price by $5 a month, which is something like a 40 or 50% percentage increase for Netflix. But for me, it's $5 a month. I think I might decline that, right? I think I might live with the less expensive version,
Right,
as we prioritize. And I think a lot of people are going to start making those tough decisions. And that's what I'm talking about here. And that makes a lot of sense, doesn't it? To just figure out, well, what is most important?
Yep, that's exactly right. Well, I think we have strained the the I don't know. I don't want to suggest that this has just been a very heavy topic. We've pushed this to the limits, and we want to go easy on our listeners and help them at least find some hope, like you say, in the opportunity that is abundant right now. Yeah,
And
inflation's real, but so are the things that the positive things that are in front of us, I think, are also very real and need to be embraced.
well, yeah, I mean, if we end with anything, let's end with Starlink, which is absolutely astonishing, amazing technology that is bringing, the next century of communication to the most rural parts of the world, like where the Merrills have built their homestead, out there where nobody lives, right? You and the tumbleweeds, and Ukraine, and that's awesome. So yeah, you are going to probably make the decision to pay a little bit more to keep that service, and that's an awesome business opportunity for them, right? And so there's wonderful things like that are happening that are taking advantage of the inflation and that are right in alignment with our priorities, because we can do something we couldn't do before. It's pretty cool.
Yeah, I'll end with one comical anecdote that kind of brings some of this prosperity and quality of life that we all enjoy into perspective. I was given a newspaper, I think it was the Denver Post or Rocky Mountain News it was actually the November 4th or whatever it was from 1980. It was the announcing that Ronald Reagan had won the election. A friend of mine knew that I found particular interest in that sort of news. And I was looking through the newspaper and saw in the ads, mortgage rates or interest savings rates. I think it was savings rates at 14%, CDs at 16%. And, but what also stood out to me, not only just the interest rates and where they were at the time, but it was you could buy a new TV, like a 20-inch, tube TV for like $550. And you know what? You can buy a 50-inch flat screen TV right now for $550. So there are deflationary pressures in the market as well as these inflationary pressures. There's that kind of technology. Not only did it simply not exist back in 1980, but when plasma TVs first came out, they were like 10,000 a pop, and so there are things that we enjoy, Starlink included, that are just space age technology, literally, for other comparative periods of what we're going through, and our lives are pretty darn good in comparison.
Absolutely. And if you inflation adjusted that $500, that would be more like 2,000. I mean,
Right.
It's awesome how much our quality of life has increased during our lifetime. It's
Right.
And that trend is one that is long-term and likely to continue. Absolutely.
Thanks to the free markets. So on that note, thank you for joining us today, Carl. Really appreciate the work you did to pull together this topic on relatively short notice and made this an enjoyable discussion. So I appreciate it.
Nate, this was a lot of fun. Thank you for inviting me to be here, and I look forward to seeing you again soon.
Have a blessed day.
Great, beautiful day.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.